We log into our brokerage accounts, see numbers flashing green and red, and accept them as reality. We treat the prices on our screens as the absolute truth of what a company or a commodity is actually worth. But those numbers are disconnected from the real world. Modern financial markets run on a system of paper promises, entirely detached from the physical assets they claim to represent. That gap between the screen and reality is snapping shut. We are looking at two impending deadlines: an August 6th lockup expiration for SpaceX and a July 24th shock to the global gold market. When you build a market on artificial constraints, the math eventually catches up. The breaking point forces a violent correction, leaving us to see who actually holds physical value and who is holding a paper bag. Consider the recent volatility in SpaceX. Its secondary market valuation was priced at a record high of $135. Recently, that price has slid toward $116, a 27% drop from those previous peaks. That high price was sustained by a share lockup. When early investors and employees are blocked from selling their equity, the market chases a tiny pool of available stock. The price stays high because supply is kept under an artificial lock and key. But beneath that price action is a structural confusion across Elon Musk's tech empire. Investors are increasingly concerned about a growing divide between his different companies regarding who actually owns the hardware. For example, the massive new data centers being built for xAI are not owned by xAI or Tesla. The computing power and physical GPUs for these projects are housed under the SpaceX umbrella, creating a bizarre disconnect for anyone valuing the individual businesses. This creates a direct conflict for Tesla. While competitors like Waymo have a direct line to their own infrastructure, Tesla is expanding its robotaxi service to new cities, while its essential AI brains are legally controlled by a different company. This means Tesla's multi-billion-dollar valuation depends on hardware it doesn't own. When a company's future hinges on assets controlled by another entity, the valuation is only as strong as the legal agreement holding them together. The tech sector operates on artificial scarcity. The precious metals market operates on the exact opposite, artificial abundance. This is paper gold. When most buyers purchase gold on an exchange, no metal actually moves. A bank simply writes a contract saying you own an ounce. Sellers know almost no one will ask for delivery, so they sell 10 claims on the same physical bar. That phantom supply floods the system and forces the daily traded price down. Governments have tried to control this before. In the 1960s, the US dollar was tied to gold at a strict $35 an ounce. As Washington printed more dollars, the physical gold didn't multiply to match it. European allies did the math. They realized the paper dollars were losing value, so they demanded their physical bullion instead. To hold the price down, the US loaded military aircraft with thousands of tons of gold and flew it to London. The ensuing run on the metal was immense. By March 1968, 780 tons of gold were trucked to the Bank of England. The sheer weight of the stacked metal literally collapsed the wooden floor of the historic bank's weighing room. The government had to shut the market down and abandon the $35 peg entirely. When paper claims and physical reality disagree, the sheer weight of the physical metal always breaks the fragile paper system. Both the tech and precious metals markets are heading straight for their own physical reality checks. For SpaceX, the deadline is August 6th. That is the lockup expiration date, where many employees will finally be permitted to sell up to 20% of their equity holdings. Staff who have worked for 5 to 10 years for stock instead of a full salary will want to secure their financial futures. That sudden flood of available shares eliminates the artificial scarcity, finally testing the real market demand for the stock. Over in the gold market, the date is July 24th. The largest banks in China, including ICBC and Bank of China, are entirely shutting down paper gold trading for their retail customers. They are permanently terminating the margin products. Without those derivatives, trades on exchanges like Shanghai will have to settle exclusively in physical metal moving from one vault to another. They have been preparing the infrastructure to handle this demand. The Gold Vault at Hong Kong's International Airport is expanding its capacity from 150 tons to 1,000 tons of solid metal. You don't build space for an extra 2 million pounds of physical storage unless you expect real metal to arrive. These dates act as demolition charges, blowing up the artificial constraints and forcing the paper numbers on a screen to reconcile with real-world supply. Once these artificial constraints are shattered, the structure of these markets changes instantly for everyone involved. The friction between Tesla's autonomous goals and SpaceX's hardware ownership creates a valuation trap that is increasingly hard to ignore. To resolve who truly owns the AI assets and fix the financial disadvantage for Tesla, some major investors believe the only clean path forward is a full corporate merger. In the commodities market, pulling the plug on derivative contracts removes the phantom supply. The result is pure upward price discovery, as buyers demand physical metal that actually exists. Financial security doesn't live on a glowing screen or in a highly structured shell game. At the end of the day, reality asserts itself, and value returns to the people who hold the physical assets in their hands.